I'm Jeremy Shepherd.
And I'm Damien.
We use data to expose deceitful property experts and their marketing BS. This is the Expert Busting series.
This is part 3 of the Expert Busting series, and today we're going to be exploring new versus old, the nasty truth. Jeremy.
Yeah, so new properties versus old properties. We're going to find out in this presentation just how unlikely it is for a new property to come anywhere near the performance of an established property. And we're going to go over depreciation, uncover the nasty truth about depreciation, why it's to be avoided. And finally, we're going to figure out the one metric that every property should have for above average capital growth.
Alrighty, so starting off with depreciation benefits.
Yeah, so this is one of the biggest selling points of new property, the spruikers of new property, depreciation benefits. The thing is, there's nothing beneficial about depreciation. So you stop and think about it for a second or two. As an investor, you're looking to buy an asset, not a liability. An asset grows in value. It appreciates. It goes up. A liability depreciates. It goes down in value. So how on earth can depreciation be considered a benefit? This is one of the biggest lies in the property investment industry. This term, sometimes I still catch myself saying depreciation benefit. There's no benefit about depreciation. So what is depreciation? It's the loss in value of your property as it ages. As the building gets older, it becomes less valuable. So land, that appreciates over time. It gets more expensive, but the building goes the other way. Depreciation is an estimate of the amount of value that a property has lost since the day it was constructed.
And I guess the way you can also, in a simpler way of explaining, is you buy a car for $50,000. A year after, it's worth, let's say, $45,000. That's sort of 10% depreciation. It's the drop in value of the vehicle, as an example.
Yeah, and a lot of hi-fi tech depreciates very quickly because technology is evolving so rapidly. But yeah, it's the building that depreciates, the land appreciates. So the depreciation, if you just come back one more slide, thanks. Depreciation is a dollar estimate of the loss in value based on the age. And there's this group of people, they're called quantity surveyors. They have a very special skill. They're experts in this topic. They've learned how quickly certain items depreciate. For example, a hot water system versus air conditioning versus carpet. There's an enormous number of things, including the building itself, that depreciate over time. And the quantity surveyor can list all of these items of a house or of a unit, and they come up with what's called a depreciation schedule, which shows in dollar terms how much money is lost due to aging of the building.
And that comes from the Australian Tax Office. So it can change over time, but that's where it comes from.
Yeah. Now, there's this fundamental law in tax law in Australia and in many other countries around the world. You only get taxed on net profit. So losses are offset against income to calculate net income. For example, if you rent out a shop and you sell donuts, you don't pay tax on the full amount of money that you receive from selling those donuts. First of all, you've got to take out maybe wages and other expenses like electricity and water and the rent that you pay.
Labour.
And yeah, the labour. And another expense is depreciation of your donut machine or your fridge or your closet or your security camera or your doors. All those sorts of things, they depreciate over time and you pay tax on the net amount. And it's the same for an investment property. It's just like running an accommodation business. You have property expenses, which are offset against rental income, and the net figure is what you pay tax on. Depreciation is just another one of those deductions that you can claim. Your donut machine ages, losing a little bit of value each year, and that little bit can be claimed, your investment property ages too. There's no leg up specifically to Australian property investors. This is just a standard sort of business law that you are paying tax on the net proceeds minus depreciation.
And you can always talk to your tax accountant about this. So think of it as if it's an income producing asset, do those deductions, are they associated with that income producing? So I guess from a property perspective, it could be interest, council rates, insurance, management fees, repairs and maintenance. And obviously depreciation's the other one there. So they're examples. There might be more there, but that's sort of the bigger ones that we've got.
Yeah, and there's a depreciation schedule, an example of one on the next slide. Do you want to take us through this, Damo?
Yeah, so what happens is, let's say you purchase a property. So let's look at a brand new one specifically. There's typically a 40-year term with, for example, like capital work deduction. So Division 43, and Division 43 is that building component. So let's say you can claim that at 2.5% per annum. So let's say you build a property for $500,000. What would that equal? About $12,500 in depreciation every year, roughly, Jez?
2.5%. Yeah, but they usually use the diminishing value approach, don't they?
Well, so you can pick. I think you've got the diminishing value and you've got the prime cost. So there's two aspects. If it's a brand new property off the plan, you've got Div 43, which is just the 40 years that you can claim over time. And then Div 40 is your other components. So it could be appliances, carpets, blinds, and they roll it into sort of the one number. So what you do is you get a 40-year forecast from a quantity surveyor. And if we have a look at the screen at the moment, you can see that the property was built around sort of 18th of June. So there might be 12 days till that end of financial year finishes. And there's, let's say, roughly about 2,700 that you can claim back against your taxable income for work. So let's say through the year, you get your assessable income from the ATO, and let's say it's 100,000. And then what happens is you've got that 2,700. You don't get that back as a full amount. It just reduces your taxable income. So instead of paying tax on the 100,000, it's more like you'll pay tax on, what's that, 97,300. So what this allows you to do is, all it does is reduce your taxable income, which sort of improves your cash flows. But in the following years, you can see here you've got the whole year for the end of, I guess, financial year 2020, 2021, 2022, and you're claiming a big chunk of that. So 15,000 you can claim on the next year, then 17,000, 15,000. So there's a little bit of a spike up here. Maybe I'd have to double check what that might be there. But you can see it's quite consistent throughout, and the diminishing value sort of claim more upfront. So you're sort of getting that benefit back a little bit earlier, which means it helps with cash flows a little bit earlier. But later on down the track, the prime cost from a cash flow perspective is you're getting more deductions later on. So again, you have to look at your circumstances and tie in with your accountant. So I would think that you'd want a lot of those deductions maybe earlier on if your taxable income's higher. But let's say, for example, I'm only working part-time or 2 days a week, then maybe I'm happy to go to that prime cost method. So long story short, you get a report, and even if you buy a property, let's say it's only 10 years old, as an example, you might have $30,000 worth of depreciation that you can claim, but you can't go back and claim those first 10 years because it's already passed.
Yeah, it's taken from the construction date, isn't it?
Yeah, like another example could be like, you buy a new air conditioner, you can claim that over 10 years potentially. So, yeah, that's sort of like
and I think
later on.
What this schedule shows, one really important point here is that new property depreciates faster in its early years, and then it starts slowing down until eventually it gets to a point where it's just not depreciating at all.
I think it's, so the 40-year, I guess, depreciation that you can claim, I think it's for buildings constructed after 15th of September 1987. So anything before that, you wouldn't get those depreciations on that building component, but it's already sort of been, it's coming up to 40 years now anyway. But normally if you buy a property, let's say that's, maybe it's been around for a while, it's a 40, 50, 60-year-old property, you'd have no depreciation whatsoever. So normally you'd talk to a quantity surveyor either way, and they'd be like, yes, we'll give you a report based on what we can see, or maybe there was a renovation, so you might be able to claim that because that's a capital improvement. You've added value. So an example would be maybe you extend the house. So they might be able to add a value that you can potentially claim. But yeah, with a lot of these reports, any properties that are established that are older, you wouldn't be receiving these depreciation. I won't call it benefits.
Don't say it.
I won't call it benefits, but depreciation.
Yeah. So if you move on to the next slide, let's go through an example. The numbers for this next slide are made specifically simple. So there's a really important point here. You don't get back everything that you claim. You only get back a portion of it. So let's assume that you've bought a new investment property and it depreciates by $10,000 in the first year. Now, you claim that deduction against your taxable income and it reduces your declared income by that $10,000. Now, if you're paying tax at a marginal rate of, say, 40 cents in the dollar, then you'll pay $4,000 less tax because your taxable income has been reduced by $10,000, and that means you pay $4,000 less tax. Now, that does not mean you are better off by $4,000. It means you're worse off by only $6,000. So you lost $10,000 due to depreciation, but because of the tax claim, tax deduction, it's not as bad as $10,000. It's only as bad as $6,000, but it is still bad. In other words, it is still worse than someone who purchased an existing, established investment property that has zero depreciation.
So I think let's use this as an example. Let's say you've earned $100,000 in the year. Instead of paying tax on that $100,000, it would be reduced by that 10. So you're only paying tax on that $90,000, and that's where you multiply it by that marginal tax rate. And we're using round numbers here, so it wouldn't be 40 cents. Let's say you're in that sort of 37-cent bracket, 37%. You add the Medicare surcharge on top, that's 2%, so it'd be around 39, but we're using rounded numbers here. But the key thing is just if you think that you can claim 10,000, you're not getting 10,000 back. You're only getting 4,000. You're still worse off by 6,000. And I've spoken to some people where, I wrote off my car, or I write this off on the business, or you realise you're not getting all that money back. You're only getting back what the tax rate is. So if the small business tax is, let's say, 25%, you might have some GST component associated with that also. You're not getting that whole value back. And there's limits on depreciation with cars, for example, within businesses. And the ATO adjusts that every year. But you also have to think, if that car's declining at a rapid rate, is there really a benefit there? So you have to do your numbers. Look at the data. Don't just go, write it off.
Yeah. It's you can see that it's not a good thing. It's actually bad. It's something to be minimised, not maximised.
And look, we're not tax accountants. I did do tax law at uni a while back, but obviously dealing with a lot of clients, we sort of know what to look for and the questions to ask. So we're using our expertise here. Now, new versus old.
Yeah, so brand new properties depreciate the fastest. The newer the property, the faster the rate of depreciation. But the rate of depreciation, it diminishes over time. It starts to slow down until eventually the property stops depreciating. And according to the ATO, that's 40 years after it was constructed. Not after you bought it, after it was constructed. So you can buy an established property that's already 40 years old, it won't have any depreciation. All right, so next slide.
Land versus the dwelling.
Yeah, so why is it that new properties with high depreciation underperform when compared to established or older properties? So firstly, we need to understand how a property's value is derived, and it's based on two things: the value of the land and the value of the building that's on top of that land. And now we have an understanding of depreciation. We can do a comparison of new versus old. And this is the easiest way to see the alarming difference between the performance of new versus old. It's by doing the numbers. So let's start off with two properties. Both are the same value, but one is old and the other is new. Both were bought by investors for the same price of $600,000 and at the same time, but they may be in different locations. They may be in the same street, but that's irrelevant. The point is we've got two investors, both have the same budget. One goes new, the other goes old. Let's see what happens.
We'll look at this example, and I guess there are instances, I just want to bring up, where that $600,000 property might outperform that old property depending on the market that you're in. I think it's important to say that. So where I would see this is very relevant is if I'm going into maybe a specific suburb or a cluster of suburbs, like a local government area, this is where I think it'd be a lot more relevant because you get a lot of the similar growth rates, don't you? So then you got that new property versus that old at the same price point. This is where you'll see, I guess, a lot of the value. And I would normally say, well, that $600,000 brand new property versus a property where I'm getting a lot more land content, which we'll talk about land to asset ratio shortly, is what is really crucial to accumulate your property portfolio.
Yeah, so we could assume that these two properties are side by side in the same street. But yeah, let's just move forward. So imagine buying an older property. It could be in a middle ring suburb, perhaps not a greenfield estate, obviously. And you've got high land values, much higher than in those fringe suburbs where the house and land packages typically are. Now, the build might be old enough to be considered only worth, say, $200,000, but the entire property is worth $600,000. So the land is valued at $400,000. So we've got land worth $400,000. Dwelling on top of that has depreciated to the value of $200,000. The total value is $600,000. We're assuming this property has, say, 1,000 square metres. And we've calculated the land to asset ratio there of 0.67. That's 400,000 divided by 600,000. That's the land value divided by the total value of the property. It's 2/3, 0.67.
And where does that land valuation come from?
So that would be a professional valuer. They usually split up the value of the property into land and dwelling.
And also you get the land rates from time to time. I'd say they're a bit more conservative, I think, depending on, I guess, the state that you're in. It could be 3 years, could be 4 years, but that's how land tax can also be valued. So if you've got 3 investments in New South Wales and that land content or the land value from the council's high or the local government, you're going to get hit pretty, or federal government, I'd say, depending.
Oh, it's, yes, state, I think, isn't it?
State, yeah, that's it, state. So you'd get hit, but it's just very relevant, isn't it, that land content value. But that 0.67 is from 400,000 divided by 600, 67%.
Yeah, and that's called the land asset ratio.
Now let's move over to the new property. So
yeah, so imagine you've bought a new, let's say it's a house and land package. Now you've paid $200,000 for the block of land and an extra $400,000 to have a house plonked on top of it. Total value is $600,000. So the land to asset ratio in this case is $200,000 divided by $600,000, 0.33.
So it's like 1/3 typically. So that land is only 1/3 of the total value.
You as an investor, you've paid $600,000. Well, one investor's paid $600,000. The other investor has also paid $600,000. We've got a new property in one case, an old property. Let's see how those two properties perform over time. Let's fast forward the clock.
And I guess the land size is 327 compared to like the 1,000 square metres on the previous example.
Yeah, so if they were side by side, you couldn't have one block of land being the same size as the other block of land and being half the price. It would have to be probably a smaller block. All right, so the older property has obviously a cheaper house on its block of land. That's because the house has been there for a few years now at least. And that's why the building's only worth $200,000. It would have probably cost more to build it. But the land is worth $400,000. Now, the new property is the reverse situation. It's got a building worth $400,000, but the land's only worth $200,000. So this is typical for new house and land packages. In fact, I remember receiving an email newsletter from a property developer, and they were patting themselves on the back for having a land asset ratio of 30%. And I thought,
was that true or not?
Yeah, they thought that was great. Was I wouldn't touch anything less than say 50%. But anyway, we'll come to that. Let's just compare how these two properties perform. So let's assume that a period of time of 10 years has passed.
And I think it's important to note that we're looking at purely from an investment point of view, not to live in, because there might be individuals that were like, you know what, I want to live in the new house. I don't want to live in a bigger block, have more maintenance. So depending on the amount of new properties in the area, it might, I guess, depending on the layout and having that newer home, it might command a higher price, a lot higher price. And if there's only one or two of them in that suburb, if it's already in a built-out area, it might just continually command a higher price because it is newer. So it's not to say we're just looking at it as an overall picture from a probability point of view, old versus new, which way that we would be leaning towards.
Yeah, and this is purely from a financial perspective, no lifestyle choices.
No lifestyle. I think it's important to say that.
Property investing, yeah. All right, so you've heard that land appreciates, buildings depreciate. So watch what happens now when we fast forward by 10 years. The old property's land has, let's assume that over these 10 years, both blocks of land double in value. So the new property's land has doubled from, well, let's start with the old property, sorry. The old property's value, land value has gone from 400,000 to 800,000. The new property's land has also doubled, same rate of appreciation, but it's gone from 200,000 to 400,000.
We'll slow down a bit, Jez.
Sure.
I know you get excited with the new versus old, but so we're saying it's doubled. In a 10-year period, we're assuming that both of the land values are doubling in value.
Yeah, same rate of appreciation.
And the building value, though, for the older property is also depreciating by what, 40,000?
Yeah, so because older properties depreciate slower than newer ones, the older property is depreciated by 20% or $40,000. So it's come down by 40,000 from 200,000. 10 years later, the building is worth 160,000. The land is worth 800,000. So the old property is now worth 960,000. But the new property, same rate of appreciation for the land, doubling, 200 to 400,000. But the building has depreciated by 30% or $120,000. That's down from 400,000 to 280,000. So you combine 280,000 the building, 400,000 for the land. The new property is worth $680,000. Now this is after 10 years. Imagine buying the new property, and then 10 years later you're looking at a value of around 680,000, whereas you could have bought an old property for 600,000, and it's now worth almost $1 million. Now, it isn't as simple as this. We've got a few other factors to consider, but we're starting off with a $280,000 difference.
I think the main point there is that land value is what we really want to target, like that asset growth of what, 400 to 800 on that older property, because we've got that higher land concentration. We're getting a lot more of that appreciation because that land appreciates and the buildings obviously depreciate over time, where that newer property has a massive depreciation because it's new.
Yeah,
so it makes sense.
Yeah, let's factor in that depreciation that's claimed. And this is where the proponents of new start getting noisy, saying there's all this depreciation that you can claim. So you see that the old property owner has only been able to claim at most $40,000. Probably less since it was an established property, and they do have different rules regarding depreciation claims. But let's assume the investor of the old property was only able to claim half of the depreciation loss, which is $20,000. But remember, you don't get back everything you claim, only a portion of it, and that is depending on your marginal tax rate. So let's assume it was 40 cents on the dollar, just to make the numbers easier.
So where's that 20,000 come from, Jez? That claim?
I've assumed that the owner of the old property was unable to claim the full 40,000, only 20,000.
Okay.
Yeah. Okay. So that's why at 40 cents in the dollar, the tax saving is only $8,000 for the owner of the old property. Yeah. So the owner of the old property was able to reduce their tax payment by $8,000. That's over the entire 10-year period, and only $8,000. That's because they've got an old property. But the owner of the new property was able to claim depreciation of $120,000, 40% of $120,000. That's their marginal tax rate, is $48,000.
So that's what they get back. So you don't get back that 120, you get back the 48,
Yeah.
like after tax dollars. That's what we're talking about.
So the difference between 48,000 and 8,000, the difference between new and old in the depreciation claim is a difference of $40,000. So previously, the old property investor was ahead by 280,000. Now, after factoring in the claim of depreciation, that has dropped to only 240,000. So the owner, the investor who bought the old property is now better off by the investor who bought the new property by only $240,000.
I think, in the previous example, that new property, we've got that 120, but I think on the old property, it's around 40,000, but that's okay. We'll work off the 20. That makes sense.
The reason why it's only 20,000 in depreciation is I've assumed that the purchaser of the old property has not been able to claim the full 40,000 in depreciation because of changes in depreciation tax laws.
Okay.
So I'm doing everything to try and favour new property versus old.
So giving a lower benefit to that old property, so put more in the favour.
That's right, yeah. So that it's a completely fair comparison and people aren't thinking, oh, you guys have got it in for all us developers. This is the true difference between the two.
Because the big argument that I would see with brand new is, cash flows. It's only going to cost me $20 a week to hold this property. So it's very enticing for investors because that's what they want. I don't want it to impact my lifestyle. It's paying for itself. Great. They don't ask questions. They just sign the contract.
Let's go to the next slide and talk about cash flow then.
Cash flow.
So up to here, we've assumed that both properties have same income and expenses. That's over the entire 10-year period. But older properties will have higher maintenance expenses than new properties. And new properties may have higher rental income, like you said. Now, adding up those differences, so what I've assumed here is that there's about $1,500 in repairs and maintenance extra per year for the old property compared with the new property. And over 10 years, that adds up to $15,000 more repairs and maintenance for the old property compared to the new. I've also assumed that the new property is going to have $30 a week more rental income because people prefer new to old. And over 10 years, that adds up to $15,600. So you add those two together and the owner of the new property has been better off by $30,600 in cash flow over those 10 years.
One thing you're most probably not factoring in, and we don't need to dive into it, is like, okay, let's say there's $15,000 extra in repairs and maintenance over that 10-year period for that older property. Well, you get a deduction for that. So it's not the whole $15,000. Let's say you take away roughly 40% maybe, give or take. So it might be around $8,000-9,000 or something.
That's a good point. I haven't even factored that in. And isn't it interesting? The property developers who are selling new property will tell you about depreciation benefits, but they won't ever refer to repairs and maintenance as if they're a benefit. Instead, they'll say, you don't want to buy an old property because of all the repairs and maintenance.
Actually, that was a lot of the pushback I used to have back in a lot of the like 3-4 meetings I used to have a day with clients. There'd be people coming through saying, well, I don't want to buy an old property because of the maintenance. I'm like, what? Really? But it was a valid excuse, and then you wouldn't hear from them again. So good luck to everyone if they bought that brand new property. But and then obviously having that higher rental income, well, again, you got to factor the tax in. So you're definitely favouring, I guess, from the cash flow perspective more on the new property, which is good. Like you're putting more in the favour of that new property. So
another after-tax consideration, not added in here. If with the extra rental income, you'll be paying tax on that too.
Correct.
So,
That's
and
what I was
that
going to say.
hasn't been factored in either. So there's 2 points there that favour new property, and it still brings the difference only down to now $210,000. So old is still at this point better off than new by $210,000.
All right, so let's move over to vacancy. So vacancy is where I guess there's no tenant within the property. So I think you're saying, well, 1 week of every year on that old property, and we're pretending that it's vacant.
Yeah, so some people would argue that new properties are in higher demand because, well, they're new and therefore would have lower vacancies. Now, others might say, well, because new properties are in these greenfield estates and they're built all together in a big bunch, there's actually higher vacancies. But there is historical data to support that vacancy rates increase with increased developer activity. But I won't bother pushing that point since it makes very little difference to the bottom line. But what I've done here is factored in an extra vacancy rate of 1 per annum for 10
1
annums,
week.
and it's $500 a week rent, so it adds up to $5,000.
So after the vacancy, we're $205,000 still better off with that older property.
Yeah, that's right. It's still a very significant margin. Now, do you want to take us through stamp duty savings?
Yeah, sure. So I think with stamp duty, obviously with a lot of the states, they've got their own, I guess, stamp duty that they factor in for a purchase. So it's how the government makes a substantial amount of money. But I think normally with a lot of the land and house packages, you can do it 2 ways. You can pay stamp duty on just the land, and then you build the building later on. So you're only paying, I guess, you're paying stamp duty on the lower amount. So for that land and house package, the stamp duty is going to be lower, and it's a good selling point. Or at times there is a land and house package you buy and you pay the whole stamp duty. So it gets registered, gets built by the developer. But I think what we wanted to mention was, well, with that original property at, I guess, that land value of around, well, let's say 600,000, and then 200,000 on the so the 600,000 on an old property, you pay it for the land and the building, the whole amount.
Yeah,
I buy a property for 600,000, I'm liable for that whole 600,000 from a stamp duty perspective. And there's calculators online, you just type it into Google. But the other thing is, on that build of that land, you're only paying stamp duty on the 200, not that whole 600.
Yeah, so the buyer of the new property purchased $200,000 worth of land. They paid stamp duty on $200,000, but the buyer of the old property bought the whole thing for $600,000, so they paid stamp duty on $600,000. So the difference between them is the stamp duty on $400,000.
And stamp duty is different, like in every state. So like Queensland's a little bit lower. Then you got New South Wales, you got Victoria, you've got South Australia. So they're all different. But I've just used 4% as a rule of thumb here. So if there was that $400,000 difference at 4%, you're better off $16,000 with that newer property, but you're still better off after everything we've factored in so far. You're still in front with that older property by about $189,000.
Yeah, $189,000. That is still a pretty big difference for two properties that were essentially the same in every way, except one was new and the other was old. But there could be a couple of other things to be aware of. What about a first homeowners grant?
Yeah, so it can vary, I guess, from, again, state to state. So, like, not all the grants apply. We've just factored in $20,000 as an example here, just maybe as a grant. But you're still better off, even if we said, here's $20,000 because you're a first homeowner or a government grant, you're still better off by $169,000 even with that $20,000 benefit.
Yeah, so just recapping, to make the comparison fair, we took two properties of the same value, two investors on the same marginal tax rate. Both properties had the same rate of appreciation in land value, so neither was in a better or worse area. And yet after 10 years, there's a significant performance benefit buying old rather than new. And we factored in depreciation, higher rents, less repairs, stamp duty savings. everything, even first homeowners grants, and the difference is still way in favour of the old property owner. But it's not bad forever, because the buyers of new, once you've bought a new property, it starts aging. So eventually it will become an older property. And that's when they do start to enjoy the same growth rates as the established. And the reason is because of the land to asset ratio. All right, so let me just explain what we did mention this earlier, but I'll just explain it with some greater clarity what LAR, land to asset ratio, actually is. So the old property had $400,000 worth of land, $200,000 worth of building, totaling $600,000. Now the land is 2/3 the total value, so the land to asset ratio 0.67. Then years later, that land doubled to $800,000, and then there was some depreciation of the building, so the house came down from $200,000 to $160,000. So we get a total property value of $960,000. So if you calculate $800,000 as a percentage of $960,000, you get 83%, or 0.83. So that's the land asset ratio, which is very high, which is great. Now, looking at the new property, it started off with a land to asset ratio of 33%. That's because the land was only worth $200,000. But 10 years later, that has changed. The land has now gone, the land to asset ratio has gone from 33% to 59%. It hasn't quite doubled. And that's because $200,000 of land doubled whilst the building depreciated. So now more of the investor's money is allocated to something that will appreciate the land. Less of their money is allocated in something that's going to depreciate the dwelling.
And I think the other thing to point out, which we'll discuss, is actually it's going to be on the next slide, so we can wait to that anyway. But it's interesting to see, as you can see over time, the land to asset ratio on both of the old and the new is obviously growing because you're receiving that land appreciation.
Yeah. So what you want as an investor is, for as much as possible, all the depreciation to wash out of the property before you take ownership of it.
And I think it's also important to factor with a lot of these bigger block sizes, you might have potential to do some value add, be it a granny flat or a duplex or townhouses way down the track, but it just gives you that option if you just buy a shoebox somewhere.
Yeah, that's right.
So the next one is, I guess, why professionals should not recommend high depreciation properties. So this is an example. It's by the Affinity, by Crown Group, pretty much. It's on Botany Road in Zetland or Green Square in New South Wales. So you've got the Green Square Library down the bottom there. But you can see here, massive high-rise. The contract date on this specific unit number was 1.079 million in 2015. The build complete was 2019, so you had to wait 4 years, and then it was sold about 4 years after for 1.05 million. So it's a drop of around 30,000. And let's say from 2015 you did nothing else or didn't invest anywhere else, you'd be behind. Have all your money locked up. Imagine all those markets you could have bought into: Hobart, Adelaide. I guess Brisbane before the boom. And then it's just, you can see something like this can really hold you back. So if I guess the new versus old isn't new. Like, I think there's a lot more education around it now. But if you're new to it, this is a very good, a series or episode to understand this is why you should steer clear from, I guess, these spruikers. But it's also the land to asset ratio on a unit block like this. It'd be very, like, what would it be? It'd be 1%. It'd be below 1% because you got so many units.
Yeah, and that's a big price tag there, over $1 million.
But you'd also get smashed with things like the body corps too, with something like this with these complexes with the pools and the lifts. And
probably would have been negatively geared, so it's costing them to own. They've got $1 million allocated here to a market that isn't moving for 8 years, and then. Yeah, they paid stamp duty on this, and then they sell it. They've got to pay an agent's commission.
The argument I hear with maybe an underperforming properties or something like this is it's putting money in my pocket. it's okay. I'm happy. But as we've discussed a lot on our podcast, is around your ROI is very much limited. So you're better off maybe even having money in a bank or just some high dividend paying index funds and just having it parked in something where the excuse is, oh, it's giving me rent.
Yeah, that's right. Over these 8 years, you could have easily invested elsewhere in Australia and doubled your money.
And I think just get consistent valuations. If you're worried, look at recent sales, and sometimes you need to make that decision and just move away from these specific markets or asset. So another example, actually, so this again was from the previous example was our CPA presentation we did back in 2023. And this is another example. So purchased another unit block in Docklands. So 2016, purchased for $765,000, and 7 years after $630,000. And it's again negative growth, and this can really hold you back from your accumulation phase. And we're not just saying, just for me, it's like don't listen to anyone blindly, because there are aspects where I've seen like units in certain markets where they have had substantial growth. Like for example, a waterfront in Gold Coast, over a certain period has done crazy because there's a limited supply of that specific unit and people want to live in there. Down the south coast of New South Wales, certain areas on that Shell Cove Marina where those units have skyrocketed, but you compare it to houses in the area. So even though you think you've done really great from buying one brand new property or unit, how has it compared to other assets in those areas through that time? No one asks that question. They think, hey, I've done great. I'm going to go back to that property developer or buyer's agent or whatever it is that sells brand new. They made me $100,000, but maybe they could have made you $300,000 or $400,000.
Yeah, that's right.
No one asks these questions.
Yeah, good point.
So it's all about performance.
Yeah, so eventually an old property is going to need a reno. And it is true that a reno will come sooner for older properties than for newer ones. That's obvious. But the need to renovate isn't necessarily a bad thing. It can actually be a bonus. For example, you could spend $50,000 on a reno and add $80,000 in value if you do your reno well, and you're pocketing that $30,000 as profit. You can even knock down an existing dwelling and build a brand new one. In this case, you're now the developer, so you're pocketing that profit. You're not paying cost when you buy new, you're paying cost plus the developer's profit. So the value you add by a renovation or a rebuild, that's your profit. When you buy new, that profit goes to the developer.
The time of recording, let's just say December 2025, these days with builders... 2024? Yeah, 2024.
Where are we?
December 2024 of the time of recording. But I guess it's like with renovations, rebuilds, these days you sort of got to stay clear from it because, one, a lot of the work that's done is can be shonky from time to time, like with the contractors, and it's expensive also. So when you're looking at buying an investment that's old, we're not saying just buy any old property. Like do your due diligence and then make sure that the property's got good foundations, that you can get a tenant in there. You're not going to have any hassles with it. I think that's a key component. We're not saying just buy something that's on a big block and it's a dump and needs a lot of work, because you don't want the headaches.
Yeah.
But we're talking more about sort of side by side or similar suburbs, new versus old.
Yeah. And just one last thing after Renovate or Build, go on to the next slide.
Yeah, sure.
This is a peculiar thing about depreciation that a lot of people aren't aware of. If you ever have to sell your property and you have to pay capital gains tax, in the process, in the calculation of determining the capital gains tax that you have to pay, the ATO will claw back every cent you claimed in depreciation. The entire amount that you claimed in depreciation over the lifetime of your ownership of that property comes off the cost base, which is important in calculating how your CGT liability. And what that means is you end up paying more capital gains tax. You pay more capital gains tax the more depreciation you claimed.
Well, it's not claimed. It's even if you haven't claimed it, it still actually comes off.
Yeah.
So you need to talk to your tax professional. This is not tax advice. But normally, so let's look at an example. We should have put an example on here. But let's say the capital gain is, let's say the property is, you sell it for 500,000, okay, and let's say you bought it for, you've obviously got to factor in selling costs, buying costs, all those type of things. So that's called like the cost base. So even though you paid, let's say 400 for that property, you don't calculate the difference between 4 and 500. You've got to factor in, okay, well, how much stamp duty did you pay? How much are you paying to the agent? Let's say the capital gain now is only 70,000 instead of that 100 because you've had all these expenses entering and exiting the market. So let's say 70,000, and then you got depreciation. So let's say the depreciation of that period is 20,000. Now, instead of, let's say it's 30,000, that's a little bit easier. Now your capital gains back to that 100,000 because you've got those benefits. You've got that higher tax liability from an ATO perspective. I think it's only on the capital component, not the fixtures and fittings. You have to talk to your tax accountant. It's been a while. But that's how it sort of works. So again, talk to your accountant. But even I've seen instances where a client was actually able to claim depreciation. They never did. I said, look, go to your quantity surveyor and go back a couple of years. I think you go back maybe 2 years on your tax returns, and you can get some, I guess, I won't call it benefits, but you're entitled to that depreciation. So you might as well utilise it because either way the ATO is going to take it off the cost base.
Off the cost base.
Hopefully that's not too complicated for everyone. If not, reach out to suburbdata.com.au. All right.
Yeah. All right. Yes, the question, how do you get paid? This is a really good question to ask anyone who you plan to work with in the property investing industry is how do they get paid? If any of the money that you're about to part with goes to a developer or one of their partners, you're on the wrong side of the fence. So property investors and developers are enemies. They have opposing goals. So, yeah, when you are giving the enemy a profit, that's, you're hurting me and you're hurting yourself. So we just want to be careful of that. Just figure out, where do people come from? Do they get a commission for selling this property for the developer? Do they try and get some sort of group discount? Are they biased in some way towards new property? Because we don't make any more or less money whether you buy new or old. It doesn't matter, but we are investors ourselves and we would prefer old to new simply because of that shocking performance difference.
So, okay, you have to think with a lot of developers, what are they aiming for to make, I guess, margins on doing a brand new build or a unit, 20 to 30%? So think of, they've got their costs, they've got their labour, all their expenses. Do you know roughly how much they're trying to make off every unit that they sell or land and house package? I'd say 30% is the sweet spot.
I don't, but let's go through some hypothetical example in the next slide. So you put yourself now in the shoes of a developer. How are you going to maximise your profit? Now, developers, they make money from adding value, right? They buy a cheap block of land, they build a McMansion on it and flog it off for as much as they can. Land and construction are their big costs, obviously, so they want to minimise those and they want to maximise the value add. So here's a relatively unprofitable project. You buy land for $1 million, you build a cheap house on it for, say, $400,000. That's very cheap. And then you sell it with a $100,000 markup for 1.5 mil. That is a very small profit. In fact, that's a return of only 7%. So this is a terrible development project. And the reason why is because the land was such an expensive proportion of the total project cost. Land is an expense that a developer wants to minimise. And if you look at the next example, this is still bad. Now imagine the same house was built but on a cheaper block of land. So this is a more profitable project, but it's still pretty bad. Let's say the land is a lot cheaper, half the price, and only $500,000. The building, it's the same cost, $400,000, again, very cheap, but it now represents a slightly higher proportion of the overall project cost, right? So the return on investment for this case is 10%. Bad, but better than before. So the value added as a percentage of the total spend is now higher. And the developer is, of course, paying less for the land. So the profitability is much higher in this case, but it's still not good.
And with a lot of these volume builders, they obviously want to get through these pretty quickly, because the quicker they get it done, the quicker that they get paid.
Yeah. Now, have a look at the third example.
And normally too, is like you said, the block sizes would be super small. So if you look at these maybe estate areas, they're going to be chopped up quite small. So if I was looking to maybe, let's say I wanted to live in a brand new house and buy that block, I would be targeting maybe that higher block size, depending on where it is. I guess you can work out maybe how much per square metre it is per dollar. Are you getting more value down the track? Again, you'd have to do your numbers, but I just thought I'd throw that in there.
Yeah, so on that point, here's a much more profitable project. This is the third and final example. So the land, let's assume the land now is very cheap at only $200,000. The build is still $400,000, but that now is a much higher proportion of the project cost. And so the ROI comes out to 17%. Still nothing attractive, but you can see from those three examples how lowering the land cost increases the ROI. So if you're a developer, you want to minimize the cost of the land. The land is an expense. It's a nuisance to the developer. So developers want the lowest possible land to asset ratio to maximize their profit. But what do investors want? We want the highest possible land to asset ratio to maximize our profit. And this is why investors and developers are completely opposed to one another. We are enemies. Developers just don't build what we want. So don't buy properties from developers. They are very poor investments. All right.
From an argument point of view, I guess we've already mentioned it before. Jeremy, I've made $500,000 from this brand new property.
How did the established properties in the same area perform?
Good response.
Yeah, so it's not impossible to make money from buying a new property, and I have heard of people making stag profits. They offload the property after purchasing it, maybe only a year or two after owning it. But the point is that in that area, there is probably going to be an established property that will give you better growth, better returns.
The way I always frame it is probability. If you look at all of Australia, new versus old, the old properties are going to outperform the new. You might cherry pick, these developers will cherry pick these brand new properties. How I've made this much for my client, social proof, yada, yada, yada. But if you look at it from a probability Australia-wide, that's how you can make that decision that old is better than new.
Yeah, and the numbers that we've just been going through help to prove that. But here's some historical evidence. So that maths was quite compelling, but what has actually happened is in this data set right here. So I got some data this is from the Queensland government. It's on building ages, and I plotted the age against growth. So age, dwelling age versus capital growth in percent per annum terms. The newer the property is, the worse the growth has been. So that bottom horizontal x-axis, that is the age of the dwelling. So brand new properties, what sort of capital growth have they had historically? It's less than 4%. And you can see the trend line as property gets older. That's the purple dashed line there. That increases the older the property goes. Now, it only goes up as far as 15 years old. You can imagine that levels out. So there's not a lot of difference between, say, a 20-year-old property and a 40-year-old property, but there is a big difference between, say, a 10-year-old property and a brand new property. So brand spanking new property is likely to underperform older properties by as much as 2% per annum on average. But as we mentioned before, as time passes, eventually the growth will match that of older properties.
With that capital growth there that you've got, so those earlier ones, you can see what that Is this all of Queensland suburbs? Are you talking? Is it
Yeah,
like
across Queensland, across its history.
Okay.
There's something like 1 million transactions involved here.
Interesting. Alrighty.
Yeah, over a very long period of time.
Conclusion: don't buy new.
Yeah, general rule, don't buy new property. The performance is going to be pretty poor. You can still make money, like you mentioned, but it's just less likely. And the maths shows how unlikely it is. Historical data confirms that maths. If you want a new property, build it yourself. Knock down your old home and build a new one. Then you're getting that profit margin that you, instead of paying a developer for it. But once it's built, you're probably better off offloading it, selling it, because over time, it's going to depreciate, and quickly.
Unless it's your owner-occupier.
Well, yeah.
That's the only caveat, isn't it?
This is all for investment properties.
Investment properties. Alrighty, well, thanks for tuning in to episode 3, New versus Old. Hope you enjoyed it. See you then, and take care, and looking forward to the next Expert Busting Series, episode 4.